Before we jump into the details, I'm just going to have Jesse put up a quick poll question. Obviously, we're talking about captive insurance companies today, and I'm just curious to know how many people who are on the line have had some exposure to captive insurance planning. So, Jesse, if you could put the poll question up.
Okay, we're getting good response. Half of the audience have responded, so just get a little more participation. All right, Scott, I'm going to close the poll and show the results to everybody.
Great.
The audience or the viewers have said that 35% of them have worked with captive insurance with their business clients, and 65 said no.
Okay, great. Well, for those of you who said no, this could be an interesting hour for you, I hope. Here's the sort of agenda for today. We're going to start out where some people might think is the back end, which is what are the benefits of using captives. But I find that if people sort of understand where we're going and why we're doing this, it makes the whole presentation a little bit easier. We're also going to go to the business owner profile. So this is really sort of a look at who might be a really good candidate, what type of business owner, what type of business, what industries might be good candidates for captives. And then we'll briefly look at a case study so you can sort of see the whole thing in action, and then dive into the details with formation, taxation, and application. That should take us about an hour, and as Jesse mentioned, we will stop in the middle to deal with some questions, and just know that you can type your questions in anytime you want, and Kyle will be watching the question box, and so if you have a question, he will try and attempt to answer it as we go through the presentation. But then what we'll try and do is probably have him repeat some of those questions to make sure that the audience can get a benefit of them. So let's take a look at benefits. Why would people want to do captive insurance companies in the first place? What we have found is that business owners oftentimes are reinvesting all their money in their businesses, and they have very little cash around for emergencies or for times when business may not be doing so good. I don't know how many people saw the USA Today. I usually don't get it, but I'm in a hotel in San Diego today, and so I was looking at the headlines, and the headlines are, you know, millions of people are going to be losing their jobs. Millions of dollars are not going to be spent in the military as a result of sequestration. Now, I don't know what impact that's going to have on every business, but I can tell you that there are some businesses that at InKnowVision we're working with where that's going to have a major impact on cash flow and profitability, and also it's probably going to mean a huge reduction in employee base for a lot of these companies. You just never know what's going to impact your business, and we're oftentimes working with business owners and encouraging them to build sort of rainy day funds outside their business so that if something like this comes along, they're much more able to weather it. So wealth accumulation is clearly one thing that we're focusing on for business owners. Favorable tax treatment. The captives, as you'll see in the presentation this morning, have relatively favorable income tax treatment. There can also be some good estate tax or gift tax pieces to this. Then we've got the next bullet, which is to minimize or reduce insurance costs. Almost every business owner I've ever talked to, when I talk about insurance, complains about the cost of their general liability and business insurance packages and so forth. So one of the things we're going to be looking at when we do an analysis for a business owner is whether or not there's any way to use the captive to reduce third-party insurance costs. And oftentimes there is, either through increased deductibles or reducing some coverage and having the captive taking some coverage for losses in excess of a certain amount and this sort of thing. So clearly we're going to be on the lookout for that to try and reduce some outside insurance costs. Customized risk coverage. Some companies, some industries can benefit from having risk coverage that they might not be able to get affordably elsewhere, or might not be able to get, period, because of their location in the country or the type of business they're in, or they might just find that the coverage is too expensive. This allows them to essentially design a program that fits them. Increased cash flow. Again, you have increased cash flow possibilities from a captive insurance company really in a couple different ways. One is potential reduction in taxes, but also this idea that we may get a reduction in premiums as a result of the captive. And then wealth preservation. This is the idea of using the captive to essentially build a pool of wealth for your kids, your grandkids, and so forth, and then asset protection. The captive insurance company has some very interesting asset protection aspects to it, which, if we have time, we will get into today. So let's take a look at who the best client is to consider a captive insurance company. And this is sort of the minimum, requirements. I mean, as you start getting into this area and you start working with people and talking to them, you may find someone who looks like the perfect candidate, and then when you dig in a little bit, you'll find out that for one reason or another, they're not really going to be a great candidate for captive insurance. But I think if they meet all of these requirements, you're going to find that you at least have somebody who is at least a decent candidate for captive insurance. So number one thing that you're looking for is a successful business owner, successful business, successful professional, successful profession. If they're not successful, if they're not making money, they're losing money, or they're marginal, they're not profitable, they're just not going to have the money to do this sort of a transaction. So you can pretty much write them off. We'll get into more detail about what that means in a couple of bullets. They have uninsured risk, or they have insurable risk that they would prefer to try and insure through their captive. I can remember back a couple of years ago to a call that came in from a CPA firm looking to see whether or not a captive might be appropriate for a client. They were, meeting pretty much all of these bullets except for one. They did, because of their situation, they didn't have any real uninsured risk that could be insured by the captive, and so they weren't a good candidate. And they were basically a one-person consulting outfit, believe it or not, that was doing about $4 or $5 million a year in revenue, but it was really just a consulting sort of a thing. I suppose if they gave bad advice, they could have been sued, but the problem was they'd been doing this business for 12 or 15 years, I don't remember so much today, but a long time, without ever having a claim. And so it just would have been almost impossible to work with them. So even though they were profitable and they met the other requirements, they just couldn't do it because they didn't have enough insurable risk to justify the captive. Gross revenue number, you want to have gross revenues of $10 million or more, and the more the better. And you want to have taxable income and free cash of at least $500,000 or more. And again, you'll see as we go through this, I think towards the end we'll be talking about the fees for setting up and maintaining a captive. It's not a giant expense, but in the grand scheme of things, but it's not free either. There's quite a bit of stuff that you have to do to get it going and to maintain it. And so those are relatively fixed costs. So the more you can use your captive in terms of premium dollars relative to the fixed cost, the better outcomes you're going to have. But I would say that if you have a business owner that's able to have at least $500,000 in premium, that the captive will start to make sense at that level. Just to continue on a little bit with profile clients, here are some industry areas where you would see that it could be a good idea to consider a captive. So we've worked with developers and general contractors and subcontractors. We've worked with manufacturers. Really, manufacturers, I would say, are ideal candidates. They have lots of employees. They usually have products. They usually have shipping, distribution, and all of that stuff. They usually have contracts with suppliers and contracts with customers. They often have a number of key employees. So there's a lot of potential for insurable risk with manufacturers, especially older, established manufacturers where, obviously they've been around for a while. They're going to be a really good candidate. Professional service firms can be good. Franchisees, especially if they're owning a number of different restaurants, can be good candidates. Physician groups can be good, and hospitals can be good. And probably some people are wondering why a hospital would do a captive, because they're nonprofit and so they're not paying any taxes. And even though there is good tax benefits here, I just want to emphasize that there are a lot of real risk management issues that can be dealt with through a captive. And hospitals are really taking advantage of that. If you are able to go to any of the larger captive conferences that are put on a couple times a year, I know I think the last one I went to a year or so ago was in Cayman, where they do a really big conference, very well attended. You're seeing probably at least a third of the attendees are hospitals, and they're really focusing in on risk management, because they've got to find ways to operate essentially more, even though they are nonprofits, they have to find ways to operate more intelligently and more efficiently, and the captives have essentially allowed them to do that in some areas. Let's take a quick look at a case study. This is a client of ours that we've been working with now for a couple of years, maybe even a few years, 4 or 5 years. They're a manufacturing company based in the Midwest. They're a C corporation. They have about $35 million in annual sales. They have operations inside and outside the U.S., about 300 employees. Their net profit is around $4.5 million. I think last year they did closer to 5.5 or 6. Pretty profitable, definitely growing, and they have a lot of insurable risk. The underwriter that came in to analyze this particular business and what their insurable risks came up with about $2 million in premium worth of insurable risk. This is sort of a two-part exercise. There's an underwriter and there's an actuary that are typically involved in these cases. The underwriter is looking for what the risks are, and then the actuary is looking to price those risks and figure out what the premium should be for those risks. But nonetheless, so this sort of look and see exercise to see what kind of risks were out there generated a quote of about $2 million in premium. That was possible. In this particular case, the business owner elected to move forward, so the captive was formed. And then what we did was go through the possible coverages that were available, and this is again based on the underwriter's analysis and the actuary's analysis. And the business owner basically selected those coverages out of the group that they felt were most applicable to their business and the ones that they felt they would want to be covered for. The captive made an 831B election, which we're going to get into in more detail, and then the premium paid was $1.2 million, which ties in. Those of you who have worked with captives know that ties into the 831B election. Those who haven't, I'd ask you to just hang on for a second. We'll get to into the nitty-gritty in a minute. So premiums paid of $1.2 million. From an income tax point of view, and I know we work with a lot of CPA firms throughout the country on this sort of thing, and they're very interested in what's the income tax impact here. First of all, the premium is a deduction to the manufacturing company, so that's reducing taxable income for the manufacturing company by about $400,000. The captive, because of that 831B election, doesn't have any taxable income on the premium it receives. And so we'll repeat this a couple times, but basically if a captive elects makes an election under 831B, it can exclude from taxable income any premium that it receives for insurance coverage up to $1.2 million. So in this case, you've got a deduction on one side and no taxable income on the other. In year two, we've got the same situation, a deduction to the manufacturing company, which again saves that company about $400,000 in income tax. And again, it's going to be different. I mean, if you have a company that's got a big state income tax, that could be different. But just giving you a general idea here. And then the captive now has some taxable income. So we've got two entities here. We've got the manufacturing company and we've got a captive. The captive has some taxable income because they've got, they had $1.2 million that they invested, and even though it's got to stay in cash or very liquid investments in year one, that's still going to generate a little bit of interest or a little bit of earnings, and the captive is still obligated to pay tax on its investment income. So it's not paying tax on its premium income, but it still must pay tax on its investment income just like normal. When you're thinking about a business owner, or if you're a business owner thinking about using a captive, basically the process or the steps in the analysis is start out with a financial qualification, and that just goes back to almost the first slide. Are you really a good fit for a captive? Do you have enough profit coming in? Do you have enough gross sales? Do you have enough insurable risk, which is the risk assessment? That's the second part. The risk assessment for us anyways typically involves, again, an underwriter on the phone with the business owner, possibly with other officers from the business. If they have different business lines, then we would be wanting to have those people in charge of the additional business lines on the phone. And what we're really doing is just asking a lot of questions and having a kind of an open conversation about really what are the things that bother the business owner, what keep them up at night, what are some of the things that could be insured that aren't currently insured. That's really what we're looking for. And then an assessment, is there enough risk to justify the cost of setting up the captive? And so that's the cost-benefit analysis. Are we getting enough benefit back from doing this versus the cost? And then once we get done with those three stages, it's really up to the business owner. Do they want to proceed or not? I mean, do they see value in this or not? If they decide to go forward, then what we're looking at now is what we call implementation, and these are basically the steps. We're going to engage a captive manager. For those of you who haven't worked in this area, whether you're working with a captive structure in the United States or you're working with one outside the U.S., they all have pretty much the same requirements, at least conceptually, and they all require that you have a captive manager who is licensed in the jurisdiction where you're working. So this is kind of their the division of insurance in any state or any country that's doing captives wants to make sure that they're dealing with legitimate people, that there's no money laundering or any of those things going on. And one of the ways that they protect against that is by essentially licensing a set of captive managers. So you'll see people have to apply to become a captive manager, and there's a due diligence process for them. And then they're essentially the frontline compliance for the divisions of insurance. They're being looked at and saying, you need to make sure that you know who you're dealing with. You need to make sure that the people are legitimate and they're real businesses and all those things. And of course, the captive managers are interested in complying, because if they don't, then they could lose their license. And just like those of us who might be practicing in front of the IRS, if you lose your ability to practice in front of the IRS, it could be problematic for your business. So same thing here, a captive manager, if they lose their license, they could be barred from doing this kind of work, and it could cause them some serious problems. You got to have a captive manager. They're going to charge fees for what they do, but they're also really it's important to have them for other reasons too. They typically bring the underwriting experience to the table, so they're hiring experienced underwriters who are going to have conversations with the business owners and determine what are the most appropriate risks to insure in a captive. They're also usually bringing the actuary to the table who's going to do the analysis based on the underwriter's report and figure out what the pricing should be for particular risks and risk coverage. They're going to help in the risk coverage selection process, so there might be 10 or 15 different areas or more where you have uninsured risk. You may want to insure all of them, you may want to insure some of them. This is the area where the captive manager is going to help. Which ones should we select, which ones shouldn't we select? Once we get to that point, it's formation of the entity, capitalizing the entity, and getting a license. This is a frustrating process for most business owners because it's like dealing, well, it's not like dealing with the government. It is dealing with the government, whether it's a state government or a government in Nevis or Anguilla or Bermuda or wherever. You know, they're all staffed by well-meaning government employees, but you know, nonetheless, all of us have dealt with the government before. It can be slow. It can be, you know, again, very non-business-like. So I just try and let business owners know up front this is going to be a really frustrating part of the process. They want a ton of information about you, a lot of detail, a lot of you know, a lot of backup, and it's just going to be difficult in year one. Be less difficult in the subsequent years. Once you've got a license, then the premium payment is made to the captive, and whatever coverages are being issued are issued in the form of a policy. The time frame involved for somebody who wants to do this, at least in our experience, the evaluation and decision making can take 2 weeks to 6 weeks for somebody who is very interested. If somebody isn't really ready to make a decision for any reason, maybe they're not sure they can commit to the cash or whatever the case might be, then of course it could take a lot longer. Some people will take a year or two to think things through and then come back when they're ready. But just in terms of the evaluation process, 2 to 6 weeks, implementation 6 to 8 weeks, and a lot of that again is just once your business owner says let's go, it's a lot of detailed information gathering, and then getting the pro formas and the budget and so forth in place, and getting the applications completed, and getting everything submitted and processed through the Division of Insurance in order to get a license. So what we've done so far is we've talked about who a good candidate for a captive insurance company might be, what some of the benefits might be that they could expect to get out of captive insurance, and then a little bit about what the process is for a business owner who is thinking about doing this kind of planning. What we're going to be doing for pretty much the rest of the time, other than Q&A, is getting into a little bit more detail on what captive insurance companies are and how they work, how the taxation works, and what jurisdictions to use and that sort of thing. So again, a little bit more detail. We're going to just start out with some basics. The captive insurance company is an insurance company. When you create this particular company, it's operating just like State Farm or Allstate or any of those insurance companies. It is a real insurance company. It's formed to insure risk, and you've got some examples. It could be general liability. It could be operating risks. It could be business risks. We have a client who has they're a subcontractor to a major Fortune 100, maybe Fortune 50 company. It's probably 30 to 40% of their profit every year. Our client, I'm saying their contract with this large company is about 30 or 40% of the profit to our customer, and if the main big company decided to terminate that contract, it would have devastating effects for our customers. So one of the things they're insuring is the loss of a key contract. We can also be looking at insuring exclusions and deductibles, as I mentioned earlier. A lot of clients that we work with ask where their captive should be formed. There are more and more choices, it seems like almost every day, for choosing a captive jurisdiction. You've got lots of choices in the U.S. I think at last count there were 26 states in the U.S. that had captive jurisdictions. I don't know how many countries there are outside the U.S. that have captive jurisdictions, but there's a lot of them. And so part of what we're doing is looking at what are the best jurisdictions to use for a particular business owner, what are the pluses and minuses, where should they actually set up. If you're going to go in the U.S., and we have clients with captives in the U.S., I will tell you that Vermont probably has more registered captives than any other state. They're also the most expensive jurisdiction to go to, and maybe the strictest to deal with in the country. You typically see your large Fortune 500 companies, if they're going to have a U.S.-based captive, it's typically going to be in Vermont. That may be changing, but Vermont is definitely the home of the large company captive. I think Utah has, I think for the last year or two, Utah may be the fastest growing state for captives in the U.S. But Delaware is really marketing hard. Their division of insurance and so forth, those people are definitely holding conferences and trying to attract business to Delaware, just kind of like they've done over the years with Delaware Trust and asset protection and so forth. They see this as another way to generate fees for the state of Delaware, and it's working. If you're considering a captive outside the country, Bermuda probably has, I think Bermuda actually has more captives than any other jurisdiction, including Vermont. But again, it's sort of the high-end provider of captives, more expense, more regulation, and so forth. I would say your other two choices that are up there that we've got listed, Nevis and Anguilla, are good choices. They're solid jurisdictions. They're very anxious for the fee revenue, and they do a good job. They do a good job with the clients that we have situated there. So really it's a question for the client of, do they want to be in the U.S. or outside of the U.S., and that's pretty much driven by cost. You're going to have lower cost structure outside the U.S. than inside the U.S., but sometimes we find business owners are nervous doing business outside the U.S., and that's fine with us. It's just an explanation to them or an education point that a U.S. jurisdiction may be a little bit more expensive, and as long as they're okay with that, then that's fine with us. I want to take a look briefly at types of captives. Basically, there are two big types of captives. There's a pure captive or a standalone captive. This is a captive which is basically a single entity like an LLC or a C Corp that is completely owned by the business owner or by trust for the business owner. They basically do everything themselves, or at least they're responsible for everything. The captive management does a lot of the administrative stuff and the support teams and so forth, but it's basically a standalone entity. The other choice is a cell captive or a series LLC captive, where somebody else is basically setting up the structure and they are renting out, if you will, a cell within their structure or a series LLC within the master LLC to do it. Basically people do that when their premiums that they want to pay to the captive are on the lower end and they're looking for a less expensive solution, and maybe they're willing to give up a little bit of flexibility in operations and ownership and so forth in order to get a reduced expense cost. So you got two basic choices there. Then you also have single parent captives and group captives. So in a single parent captive, you generally have an operating company and a captive. And the captive is insuring, is really the only one insuring that company's risk. The alternative, and you'll see here a group captive, is when you might get 5 or 6 or 10 or 15 or 20 companies who come together. Maybe none of them on their own have sufficient risk or a sufficient premium to make a standalone captive work, but they know each other, they know each other's business practices, and they're able to essentially come together and create an insurance market where there isn't one. And usually this is being done, I'll give you an example, you might find 8 or 10 trucking companies who all are paying huge amounts of premium to outside insurance providers, and what they'd like to do is to cut their costs. And so they might come together and form a captive together, all insuring the same risks for each company, and essentially benefiting from good claims experience because they're all going to own this captive. So if they all drive their trucks safely, don't have accidents, don't have claims, then what that means is they each get to keep a good portion of the premium that they paid in. So it becomes another profit center for them. Or maybe not a profit center, but a good way to cut costs. Still talking about types of captives, and you probably could get this from the fact that there are jurisdictions in the U.S. and jurisdictions outside the U.S. Basically, you've got two types of situations. You can have foreign corporations, and you can have domestic corporations. The foreign corporations can either be taxed as a U.S. taxpayer or not. There are a lot of reasons why you don't want to be a foreign corporation that is not taxed as a U.S. taxpayer. Some of the reasons are set out here. I say it's much more usual for our clients who are using NIVIS or some other jurisdiction to form their captive. They're going to elect to be treated as a U.S. taxpayer. They're going to file U.S. tax returns. They're going to agree to be taxed under U.S. tax law. They're going to waive any treaty rights they might have as a result of being in a foreign jurisdiction. For all intents and purposes, they are a U.S. company. They just happen to be formed and operate somewhere else. And then, of course, the other alternative is a domestic company, U.S.-based, U.S. taxed. Nothing new or unusual really to explore there. Okay, I'm going to just stop for a second, Jesse, and see if we have any questions, and if there are, we'll take them, and if we don't, then we'll just push on with capitalization.
I've got a question that this is probably as good a time as any to ask it, Scott, and the question is if you could discuss some of your thoughts on the IRS audit risk related to owning a captive and the implications of offshore versus domestic. Which some of it I know we've just answered, but do you have any additional thoughts to add to it?
Yeah, I think that, you know, it's funny, I had an email from a lawyer down somewhere in the southern part of the country earlier this week talking about this, and he was telling me that he thinks that one of the things you want to stay away from in a captive, and I agree with this, and I know there are probably people on the line who disagree with this, so I hope I don't offend anybody, but he was basically saying that if you're going to use a captive and you're going to use it primarily as a way to get tax-deductible life insurance, which basically, you know, the idea is people are sort of marketing this idea of getting captives and then taking in captive premium and then using the premium money to buy life insurance. Then he thinks you're basically making yourself a target. And I think he has some cases in-house that, you know, that are structured along those lines. We have, you know, from our point of view, we've been from the beginning very much against using life insurance in captives. I think it, you know, and people question me on it, and I think, you know, just look back over the last 10 or 15 years for examples where, you know, I can't say why the service is upset about it, but I just know they are, you know, where they've come after the 419s of the world and the VIVAs and the 412Is and you know, I mean, it seems like every time somebody associates a tax deduction with life insurance, it's just, it's too good to be true in the eyes of the IRS, and so we stay away from it. We focus a lot on risk assessment and making sure that what the business owners are getting is real insurance. You know, and I think as long as we continue to do that, that we're, you know, that we're going to have success to the extent the clients are challenged, you know, on audit. I think that if you just, you know, if you're insuring stuff that doesn't need to be insured, I think you have a giant risk of your deduction being challenged, if nothing else, under ordinary and necessary principles. Can give you an example of a company in the Midwest that we did a review on where one of their major coverages was kidnap and ransom insurance, which may or may not be applicable. In this case, they had, no employees outside the U.S. All the employees were pretty much located in the Midwest. The likelihood of a kidnap and ransom happening was almost non-existent. So, and we told them that, and they agreed, and they ended up changing their coverages. But, I think it's largely whether you're doing this in an intelligent way or not. And if you try and do it in an intelligent way, I think you're gonna be okay. And if you don't, then I think you're going to have problems. It's, of course, no different than anything else you might do in business. In terms of the audit risk, I don't know that I have a giant comment on that. I mean, I can't. I certainly would knock on wood. I mean, I don't want our clients to be audited, but if they are, I feel comfortable going into these deals because we spend so much time and effort to make sure that the insurance is fitting their particular business and makes sense. I feel comfortable with what we're doing. But again, I've seen cases where that's not the case, and so I think you just have to, it's like everything else, you just have to be careful with what you do. And I don't mean to be preaching on this, but I think it's important to just try and be careful and thoughtful in what you're doing here. Any other questions that are coming up, Kyle?
No, I think we can go ahead and move on.
Okay. Good. So next subject is capitalization. The captive insurance companies are a lot like almost any other company that you start up. They need to have some capital, and this is typically both for a common sense point of view, but also by regulation. Every jurisdiction has its own minimum capitalization requirements, and that's part of the story. The other part of the story is that if you are too thinly capitalized compared to the risk that your company has taken on, you may find that the service, if they were to audit the captive, would say exactly that. This isn't real. And so what we're looking for is a balance. Obviously, you don't want to tie up too much company capital that could be used for operations, but you also want to make sure that you've got a legitimate situation going on. So statutory requirements, you can read them right there on the screen. This is just some examples of statutory requirements. But once you get past then, those, which you will in almost every case, then you're going to start to say, is the amount of capital in this company reasonable relative to the risks that it's insuring? And so even though you might say, wow, we should go to Anguilla or we should go to Nevis because their capital requirements are so low, you'll typically find no difference. I mean, most of the captives that we do, whether we do them in Nevis or Anguilla, are going to have capitalization of at least $100,000 or more because of the amount of risk that they're taking on. So we just have to prepare the business owners for that level of commitment or that level of investment. And again, it comes back to what I was just saying on the question. Pretty much you want to do this right every step of the way. And so you're looking for your captive manager and your underwriting team, to help you analyze your capitalization requirement as you go through this. Some of this next slide on tax issues I've hit on. Clearly, the captive insurance premium is either deductible or not to the operating company. In order to be deductible, really there's a couple of different things that have to happen. First of all, it has to be an ordinary and necessary business expense. The CPAs on the phone will, of course, understand that. And my example, I hope, pointed it out, of the kidnap and ransom insurance for a company in the Midwest with no real exposure. So you want to make sure that whatever you're insuring has a risk related to the actual company you're dealing with. The other thing that you have to have is you have to have real insurance. And again, this is an area where I think business owners sometimes can get nervous and can make a decision not to move forward. You have to have risk distribution and you have to have risk shifting. So risk distribution or risk sharing is essentially the idea that if you just have a captive insurance company that is insuring only one company, then you don't have risk sharing. You don't have the risk spread out over a number of different insureds. All you really have is self-insurance. And the service has said in a ruling, a couple of rulings actually, and the courts have said if you don't have some sharing, you don't have real insurance. Now the courts and the service have different opinions about what kind of sharing you need. You can see in the Harper Group versus the commissioner, the court basically was looking at a case where there was 30% of unrelated risk being insured by the captive. So that means out of the total amount of risk being insured, 70% was coming from the operating company that formed or owned the captive, 30% was coming from somewhere else, and the court felt comfortable that that was enough sharing to meet the definition of insurance. By the way, there is no definition of insurance in the code, so nobody knows exactly what the real meaning is. But the service came out in 2002 with a revenue ruling that essentially provided a safe harbor for risk sharing. And basically what they said was if it's less than 50% of the main company risk being insured by the captive, then that's sufficient. You'll qualify for their safe harbor. So captives that are in operation today are, meeting that risk sharing or risk distribution test by insuring roughly 49%, less than 50%, or whatever the number is, but it definitely should be less than 50% of their own company risk, and taking on the balance of the risk through other companies. So most business owners obviously don't have the time to go out and find other companies that might be interested in insuring. They're busy doing their own company business and making money. So what's happened is the captive managers have put together pooling or reinsurance arrangements where you might get 60 or 70 or 80 or 90 businesses who are all owning captives and interested in this structure and looking for a reinsurance opportunity to participate in so that they can achieve risk sharing. So this is, again, this is typically how it's done. So you form a captive, and part of the risk that the captive insures will be your company. Part of the risk that they'll insure will be the risk of the other 60 or 70 or 80 or 100 companies that are part of the reinsurance pool. And so if somebody else has a claim, then it's going to be a claim to the pool. It's the risk is spread out amongst all the business owners, which of course is why you'd like to have a larger pool as opposed to a smaller pool if you're a business owner, because if there is a claim against the pool, you would like to just have a small piece of it instead of a large piece. The reinsurance pool that we use has somewhere between 90 and 110 businesses, I believe. So it's pretty large. So if there's a claim, it gets spread out over lots of people. Any individual captive has relatively low exposure, which again is what you're trying to do with insurance. The other aspect of insurance is a little bit easier to meet. It's risk shifting, which is moving the risk off the operating company's balance sheet onto the captive insurance company's balance sheet, and that's of course what all insurance is about. So we're looking to take the risk of losing a key employee to a competitor, or the risk of a sexual harassment claim, or some sort of a product liability, whatever it is that's being insured, off the risk of the operating business and over to the captive. Okay, I've skipped over a couple of slides just because I think they cover what we've covered, or they're really fine points that I think I'd put off for another call. But for most of the captive insurance companies, again, they're either going to be formed in the U.S. or out of the U.S. If they're formed in the U.S., then this particular slide doesn't make a lot of sense. But because a lot of captives are formed, again, primarily because of cost, outside the U.S., they're foreign companies. And in order to be treated as a U.S. company, they have to file an election under 953D of the code. And basically what they're electing is to be treated as the U.S. taxpayer. Now, again, if you're on a CPA who's done this before, then you know what's going on here. But basically, the foreign company, is electing to be treated as a U.S. company for all purposes. As I said earlier, they're waiving all treaty benefits. So typically, countries, or oftentimes, the U.S. will have tax treaties with other countries, and there might be certain tax benefits granted to foreign companies. When you're electing to be treated as a U.S. company, you're waiving all of those treaty benefits, whatever they might be. You're going to file U.S. tax returns. You disclose all your shareholders. You have to name somebody in the U.S. who's going to be the power of attorney to receive notices from the service and so forth. You have to have an office in the U.S. And you have to maintain assets in the U.S. equal to at least 10% of the premium income. Again, none of these things is difficult, either individually or collectively. It's a relatively simple thing to do. It takes about a year, in our experience, to get an approval from the service on your 953D election. So just if you're going to do this and you file it, don't get nervous. It's just there's a lot of backup in getting these elections approved. Okay. The 831B election is not slightly different. It's a different election from the one we just discussed. 831B election is an election by an insurance company to be treated as a small insurance company. And only companies who have premium income of $1.2 million or less can make this election. So if you have $1.3 million or $2 million or $5 million in premium income, you can't make this election. And the closest I can come to giving an explanation as to why this situation is that you can exclude $1.2 million in net premium from taxable income is that it's essentially in lieu of having to go out and get an actuary to calculate actual reserve requirements. So again, I'm not sure why exactly the $1.2 million is the number, but I guess it was deemed to be a small enough amount that it wasn't worth the cost of getting an actuary to annually calculate reserves, and so that's the number we're dealing with. Again, regardless of whether you make this 831B election, the captive still has to pay tax on its investment income. So whether it's income from dividends or interest or capital gains or whatever, it's still paying tax. And it's a C Corp, so it's a flat rate. No special good treatment for qualified dividends or capital gains, etc. Now, when distributions are going to be made from the captive down the road, so let's say we've got a captive insurance company that's in place. It's got profits from operations because expenses and claims are not as much as premiums, which again is what you're hoping for. So you've got profits at the end of the day. And now let's say, I'm going to make it simple, let's just assume that you're going to do one of two things. Captive's either going to pay a dividend or it's going to close up operations and liquidate. And basically, if it's paying a dividend, which it could, in fact, if successful over time, they may pay dividends every year. The advantage there, of course, right now is we've got a structure where you could be paying tax on things at ordinary income or dividend rates. Distributions of dividends from a captive insurance company are going to be taxed at dividend rates. And of course, if the company is liquidated, same thing. It's essentially a redemption, and it's going to be taxed at capital gains rates, both of which are more favorable than ordinary income tax rates. So we've talked about why people might do this. We've talked about who might be a good candidate for this. We've talked about process for how these captives could get implemented. And we've talked about some of the structural details about the actual companies and then some of the tax aspects on these. Let's take a look at a couple different planning ideas that we've used and that others have used in this area. So one of the things is, from a planning point of view, is to think about who should be the owner of a captive. And typically you're going to see captives could be owned by their parent operating company, but they can also have more than one owner. They don't have to be owned by the parent. They could be owned by anyone. Here's just a simple diagram of a captive owned by a client. This can be advantageous. Obviously, the client is hopeful of having profits in their captive and is hopeful of being able to access that money down the road. And so if you've got a business owner doing this, they're probably doing it for asset protection. They're probably doing it for wealth accumulation. They're not so much thinking about it as an estate planning type of a thing. And we've got clients who are in this kind of a structure, and it's working out well for them. You could also have a captive that's owned by a trust or outright by children and grandchildren. You can have any kind of an intermediary ownership entity that you want, but the basic idea here is that you've got a client who's already fairly well off, has built up a nice net worth of their own, and is now looking at ways of transferring wealth to their kids. Now, obviously there was a lot of this going on at the end of last year, a lot of wealth transfer when people weren't sure what was going to happen with the exemption. And so a lot of our clients have gone ahead and used their exemptions, and now if they make big gifts to their kids or their grandkids, then they'd be subject to tax. Using the captive structure can be a way of helping to solve that problem. Essentially, if your kids are the owners of a company that is a successful company, then they get the benefits. And so if your captive is operated well and it has good underwriting profits, that money is going to go to the benefit of your kids and grandkids. So a lot of our clients will look at setting these captives up in trusts owned for the benefit of their kids or grandkids from day one. And in fact, this isn't a new idea. Lots of people do this when they think they've got a company that's going to be successful and they don't want to continue to increase their own estate. So I'm sure most of the people on the line have thought of this or done it. So you establish, the future profitable company in the name of the kids instead of in your own name, and let operations go on. And as long as it's successful, then all that money that's profits to the new company goes to them. So it can be a very powerful technique over time to help shift wealth. And then, of course, you've got the clients who aren't willing to give up complete control over the money. And so a lot of times you'll see a split ownership where you might have the client owning part of the captive. We did one of these at the end of last year where the client owns part of the captive and trust for the benefit of his kids owns part of the captive. And, you can't really impact the pro rata distribution of profits, so we wouldn't do that. But we do have a situation where the client would have access to profits in the future, and also kids would have access to profits in the future. And I'm just throwing this out. It doesn't have to be an all or nothing situation in terms of captive ownership. You could also see a situation where a captive was owned by a trust for the benefit of employees, so that there might be bonus provisions in there. There might be buyout provisions, so that you could structure this essentially as sort of a compensation or additional benefit to employees. And then finally, from an asset protection point of view, you've got a situation where a business owner, if they were to just take profits out of their business, and then have a claim against them from a creditor, they might have to give those profits back. There could be a fraudulent conveyance type of a claim being made there. One of the things that's attractive about a captive is that since the premiums being paid by the company are being paid in exchange for something of value, which is, in this particular case, risk coverage, then there's I think a really strong argument that those premiums are not subject to fraudulent conveyance and shouldn't be brought back in if the company gets a claim against it from a creditor. So I think there are some really good, strong asset protection reasons to be looking at captives. We're going to get near the end here, I know, because the cost slide, I think, is the second to last slide. For those of you who are interested, the costs for forming and operating a captive can be anywhere between $80,000 and almost $200,000 a year. Actually, we were involved in a client who had had 4 Vermont captives, and I think their annual costs were more like $400,000 a year. So it can be relatively expensive. We try to keep it towards the lower end of this scale. And then in terms of operational expenses going forward, you could see $72,000 to $115,000. And again, these are ranges and examples. The actual cost is going to depend on what you do and what kind of things you're putting into your captive. But as a general rule of thumb, you could think that the U.S.-based captives typically are going to be on the high side of the range, and the non-U.S. based captives are going to be on the lower side of the range. You're getting essentially the same thing, but just lower fees, less regulation, a little less compliance from the jurisdictional side of things. So the fees are going to be less. But ultimately, it's just a question of what's going to fit the particular client. So Kyle, I'm going to just, again, stop, or Jesse, and see if we have any questions that have either come in or give people a second to formulate them and ask them if they want, and see what's out there.
Okay, so we have a question from Andy who asked, have you seen a private equity-owned business pursue captive insurance as a cost reducer?
I have not seen a private equity-owned business use a captive as a cost reducer. No, I don't think I have. Yeah, I guess I would say no. I don't know if anybody else has. I think you could. It's an interesting idea. Keep in mind that captives are also used quite frequently for, not for cost reduction, but for profit centers. If anybody has ever gone to Best Buy, and I'm not sure if Best Buy is owned by a private equity firm or not, but if anybody's ever gone to Best Buy and you get a TV or you get a new stereo receiver or refrigerator or whatever, there almost always someone there asking you if you want to buy the extended warranty. And again, I don't know if you know this or not, but some people I'm sure do. But Best Buy's extended warranty program is essentially self-administered, and it's all run and administered through their own captive insurance company. If you ever bought a car and you want to get the extended warranty, that almost always, even though it doesn't look like it, it almost always is a dealer captive that's behind that. There may be a direct writing company who is doing the administration, but almost 100% of the time you're going to see that behind the direct writing company is the dealer who has got its own captive insurance company. And and again, they're looking at these things in the right way. They're saying these are additional profit centers for us. So if they collect extended warranty premiums of $1 million a year, which would be high for a dealer, but let's just say they did, and they had extended warranty claims of $500,000 and cost of administration of $100,000, they just made an extra $400,000 for themselves. So there's a lot of very interesting things that can be done here. If you're looking and keeping your eyes open and getting the right business owner to talk to.
Okay.
So pretty long answer, Kyle, for a question that I could answer no.
All right. What type of fees are typical for a cell captive?
Depending on where you're forming it, you could probably see a reduction of $10,000 or $20,000 in formation, and then a lesser decrease in terms of annual administration.
Okay. And we've got a question from John Severson's office, so they've raised their hand. John, I've unmuted you guys, so welcome to the webcast, and what's going on over there?
Well, Kyle and Scott, this whole thing of cell captive has me intrigued, particularly as it pertains to, let's say we get a group of 10 pretty progressive farmers together to form a cell captive. Would each of those have to really have about 35 million in sales to make this work, or would, if you had 10 of them, could they each have 3.5 million of sales to kind of meet that initial prospect hurdle?
No, I think they could band together. John, if you, I'm not going to go back on the slideshow, but just if you remember when we talked about types of captives, they might operate as a cell. They might also operate as a group captive. Sort of when I talked about the trucking situation. So they might not even bother with the cell. They might just say, look, we know what our risks are. We have them all in common. We all trust each other. We all know, what our claims experience has been and is likely to be. And so let's enter into essentially a group captive insurance arrangement. So I think it could go, a couple different ways. It's an interesting idea.
Well, I guess I'm not clear on now what the difference is between a cell captive and a group captive. I thought you had pure and cell. Now there's a third category called group?
Right. So a group is essentially a subset of a pure captive. So if you're a pure captive, it means it's a standalone, and it's a standalone entity that this group would put together. Usually there's one person sort of motivating the whole thing. But so it's one farmer that's motivating this, and they're going out and, getting the other 10 or 15 or however many farmers together into one group captive. It would be different if you had a cell captive where each farmer would go into their own cell. If they're in their own cell, then they're going to need to have the same, sort of sales requirements and the same sort of profitability requirements in order to make it worthwhile. Because you're not going to see much of a reduction in cost, cell versus pure. You'll see some, but I'll give you an example. The captive manager that we work with developed a cell, or it's actually a series captive in Delaware, and his pricing for the series in Delaware is about the same as the pure captive in Nevis. So this allows people who want to be in the U.S. to get essentially the same pricing as Nevis, giving up a little bit of flexibility, but not a ton, of a pure captive over the series. So it's just a way of essentially cutting costs a little bit. But otherwise, because you're in a cell on your own, you're still looking like you need to have big profits and big revenues and so forth in order to make it justify the cost.
Well, then if you're in a group captive, would each member of the group receive their proportionate share of underwriting profits, or only the host of the group captive?
No, typically they share. I mean, there's what you want to do is think about separating the host, or the person putting it together, from the owners. So let's just say you had 15 farm operations that the promoter brought together. Okay, they would own whatever share of this captive they would own. They would agree to. So maybe it's an even split. So they each own a 12th or a 15th of the captive. And so once the year end comes, they look back, they see what the claims experience has been, close out the books, and whatever the underwriting profits are would belong to, each farm, depending on what they agreed ownership was.
Mm-hmm. Well, it's pretty intriguing, because a lot of these large farm operators are forming separate trucking companies just to isolate their grain trucking liability exposure. Mm-hmm. And it seems to me that could be a potential candidate for a group captive that could be quite appealing to them.
I think it might be. It'd be something to look at for sure.
We'll be in touch. Thanks.
Okay, John. Thank you. Any other questions coming in, Kyle?
Nope.
Good. Well, thanks everyone for attending. Really glad you had the chance to be on, and really glad to be able to present what I think is a really interesting topic. Keep in mind, as I think John and I were just discussing, we're looking for real businesses with real risk here. We're not trying to play games. And if we've got the right client, it can be a good fit. I think it can be a very rewarding strategy or tactic, whatever you want to call it, for the business owner. So if we can help, just give us a call. We'd be glad to talk about a fact situation and give our opinion as to whether or not we think it's worth pursuing and how we could help you. If there's anything else we can do for you, as always, we're here, and look forward to an opportunity to have a conversation at some point to see what value we might be able to add to your business. Thanks for attending, and look forward to seeing you next month. Thanks, everyone.
The organizer had